Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 30th of April. My name is Fook Hien and I'm your host for the podcast. It has been 4 weeks now since President Trump's Liberation Day on the 2nd of April, the day he announced a broad set of tariffs on America's trading partners. If we take a step back and look at the major asset classes since the 2nd of April, global equities and the S&P 500 fell by more than 10%, but have recovered most of the losses after President Trump paused the tariffs. US 10-year government bond yields were also volatile. They fell below 3.9% and spiked up above 4.5%, but is now back close to where it started, around 4.2%. Notable changes today compared to 4 weeks ago have been in gold, up over 6%, and the US dollar, which is down by nearly 5%. On gold, that is an asset that is attractive to us amid the current uncertainty, and we have an overweight view on gold. But I want to focus on the US dollar today because it is worth asking whether we are seeing the start of a bear market in the US dollar now. The US dollar index, or DXY, has been in a range of 100 to 110 for the past 2.5 years roughly, since the end of 2022, and it has now weakened below the support level of 100. The weakness in the US dollar this month, it has happened independently of relative interest rate spreads, which suggests it was the tariff policy shock that was the catalyst for weakness. We do expect this break lower to persist as US policy uncertainty continues with risk of further US dollar weakness. And against that, we expect safe haven currencies like the Japanese yen and the Swiss franc to be stronger versus the US dollar. With US dollar to the yen, we have a target of 140 over 12 months. The yen is likely to strengthen gradually, we believe, as markets have largely priced in expectations for a rate hike from the Bank of Japan. Meanwhile, we believe the Swiss franc has the most potential to strengthen further. Our target for the US dollar to Swiss franc is 0.78 over the next 12 months. The recent strength in the Swiss franc, it has reduced the cost of Swiss imports, which brings downward pressure on consumer prices in Switzerland. This is good for the Swiss National Bank, or SNB, to keep inflation under 2%. But the SNB also wants to prevent a sustained drop in the price level as they don't want deflation. So there is a risk the SNB intervenes. However, looking at the Swiss franc's move against the euro, it has not moved so dramatically actually, and Europe is the biggest trading partner for Switzerland. Hence, we believe there is room for the Swiss franc to strengthen further before the SNB intervenes. Looking away from the world of FX, a weaker US dollar broadly could also have significant implications for non-US equities, as historically a weak US dollar has been correlated with strong performance for non-US equities, including emerging market equities. And hence, the US dollar's direction is a critical one to watch. That is all from me for today. As always, if you enjoyed the podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a great day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.